You let me know. Hello, welcome. Welcome to CAPIS's monthly research briefing. I'm Ed O'Dowd. Great to have everyone here today. Welcome, clients and friends. This is a part of our series of a monthly research call where we at CAPIS try to bring you independent research content from a variety of independent analysts. So we're excited about today's call. Today, we're going to be bringing back someone we had on the call about a year ago, Gustavo Cano of Fundamental. He was with us about a year ago on our call, and he looks at more macroeconomic charts, kind of the equity markets, fixed income. He's going to discuss a lot of topics today. Talk about the debt, the deficit, the Fed, fiscal policy. So we're really excited for that. Gustavo, welcome.
Thank you, Ed. Good morning, everyone, and thanks for having me for this monthly research call. Hopefully, you can see the screen now. Can you?
I can see it.
Okay,
Looks
excellent.
good.
So let's go. Let's jump right into it. Little bit of legal talk. Whatever I'm gonna say today, it's my opinions, my opinions only. And if you're professional investors, you know what to do with them, and it's your responsibility. In terms of the topics we're gonna cover today, we're gonna talk about reflation because we think inflation is coming back, or it can come back. Then we're going to talk, as Ed mentioned, about debt, deficits, and the credit markets. We're going to touch a little bit on the US dollar, and then we're going to go into the equity markets and what's going on with the concentration dynamic and how that's evolving and how that's moving. My idea is at the end, I'm going to talk about these, the macro themes. Then we're going to talk about a little bit about the platform we have and how to play those macro ideas with technology in your hands. And then I'll take questions on any of the topics we're going to cover. So jumping right into it is what's going on with inflation and where are we? So in this table, what you can see is a good representation of the world in terms of CPI and where are we in terms of inflation. So currently the US is about middle of the pack with a 2.8% growth on CPI. And the trend right now, even though it says lower, I would say it's more stable. Lower refers to the last reading, but in fact, it's going up a little bit from the minimums. If I show you this table about a year ago, you will see that on the column on the right, you hear a lot of green and a lot of lower. And now we start seeing those red squares with a higher trend in some of those countries. Remember that inflation, even though it's local in certain terms, inflation is a global phenomenon. And so what we're starting to see is that inflation is trending higher in some of these economies. Now, if we go back to what Milton Friedman used to say, inflation is made in Washington because only Washington can create money. And I think that's an absolute truth. Now, the question is, what is Washington doing? Well, in the chart you have, the red line is government spending, 12-month running government spending. And then in the blue line is tax revenue. So right now it looks like, using the words of Milton Friedman, government is printing money and is spending money, and Washington, therefore, is producing inflation. And the problem right now is that when you have that level of spending, it becomes addictive because you create habits. Now, I'm sure you're aware of this US debt clock. I used it in the past. It's publicly available. If you look on the top left, the highlighted area, we have about $36.6 trillion of debt that keeps growing and about a pace of a trillion every 100 days. If you look underneath, it's 7 trillion, around 7 trillion of federal spending. And if you look right underneath, that's the Dodge effort, the Department of Government Efficiency by President Trump and Elon Musk. But you can see the difference. Even though 200 billion, it's enough to be dangerous, it is minuscule compared with the federal spending. We need to get that spending below 5 trillion to make it worthwhile and to not pose a threat to rising inflation. The other thing that we touched, and I think we did it last time as well, is that inflation tends to move in waves. So what you're looking at is the CPI for the US in the 1960s to 1984. And what happened is you can see clearly three waves. If I superpose the inflation in terms of CPI of today's market, you could see that we just passed the first wave, and we're right now in the trough between the first and the second wave. Now, this doesn't have necessarily a predictive power, but if there's no control on spending, and we can see rapidly inflation picking up because of tariffs that we're going to mention, for instance, then we can have a second wave. And then if we have a second wave, then everything starts to move in the opposite direction that the government wants, the Fed wants, and the consumer wants. Now, sometimes it's very simple. It's simple math. The Fed saying that the target for inflation is 2%. So in order for us to go to 2% from a 2.8, we need to go below 2% or to exactly 2% for an extended period of time. So we are actually at 2%. And remember, us as economists or professionals in the investment world care about the growth in prices. We care about the year-on-year growth on CPI. But when we go home and we hang our coats at home and become citizens and consumers, we care about the level. And the problem is the level has been going up steadily at high single digits for an extended period of time. And right now, buying a car, buying eggs, buying groceries, buying certain things, paying for college and things like that have been increasing a lot, squeezing the consumer. So it's not only an economic measure, it's also a social measure that we need to be mindful of. Now, even though it's simple math, it happens that in Congress, they put a tilt on it. And so inflation is not necessarily a number, it's not necessarily a fact. You can have your opinion about it. And so if depending on the political affiliation, you have the Democrats think that inflation is going to go up to 5%. Independents are right now in the middle of the pack at 3.7, and Republicans think that in a year we're going to have zero inflation. Now, this is part of the problem, because in order for us to solve the inflation problem, we need to first be aware of the problem to give a solution. And that's why we have this gridlock in Washington regarding spending, USAID, and the DOGE regarding how control spending. So if we see this chart, kind of the red line and the blue line, the light blue line aligned, that means that we're getting somewhere that where it makes sense. Now, let's touch a little bit on tariffs, because it's not, I think, or we think it's not as simple as it looks at first glance. So, and I think this is a good example. In order for Ford Motors or General Motors to build an engine and build a car, you need to have different components. Let's have the pistons as an example. So we start in Tennessee with some aluminum, and then we send that to Philadelphia to create rods. And then those rods from aluminum are going into Canada, and they're subject to tariffs because Canada retaliated into the US, and they already have some tariffs in place. Now in Canada, they're shaped and polished, and then they're sent to Mexico with no tariffs, because with the NAFTA, they don't have tariffs between Canada and Mexico. But once they're in Mexico, where they are assembled as pistons, and they cross the border back to the US, they're subject to tariffs. And that goes to Detroit, and then someone like you and I, when we buy a car, we pay for those cumulative tariffs. Now, just imagine that the aluminum that starts from Tennessee, instead of starting in Tennessee, starts in Beijing. So we add in another level of tariffs. Or it goes from China into Europe, from Europe to Tennessee, and then we go again. The problem is not 25% in tariffs. It could be 50, it could be 60, it could be more. Now, there are estimates that on average, we can have tariffs of about 18% on some goods and services in the US. The issue here is that the average is not representative. You can have items that have zero tariffs and therefore no impact, and you're good. And you can have items that can have up to 50% of tariffs because they're cumulative. So we just don't know what the impact of tariffs can be. What we do know at this point is that if those tariffs are in effect imposed on all those items, it's highly likely that the actual payer of those tariffs is going to be the consumer. Yes, the government is going to collect some money from foreign economies like China and Japan. China, Europe, or Mexico or Canada. But who end up paying the bill is probably going to be the U.S. consumer. Now, The other important part is China will make a lot of headlines, and the president might say we're fighting China, we're fighting communism, and we're doing onshoring and all that. But the biggest trade partner and the one that we should really worry about is Mexico, because Mexico is the one where we get most stuff from. So it's good that we have our conversations with Canada, even about the 51st state. But the most important one is Mexico. So whenever there's a discussion on tariffs, the Mexico one is the relevant one. Now, because the Trump administration, and particularly the president, uses tariffs to do some negotiations with other economies, the level of uncertainty that we have right now in the U.S. economy is pretty big. So if you're a CFO or a CEO and you have to make decisions regarding what to do in this environment, you're confronting a level of uncertainty that it's unheard of in the last 20 years. I would say even comparable to the pandemic, believe it or not. Because in the pandemic, you knew more or less what's going on. You knew that the cost of importing goods was going to be horrible. You knew about tariffs and coming to the office, but we can't find our ways through Zoom and other alternatives. Right now, we don't even know if tariffs are going to be imposed, to whom, how it's going to affect, what's going to happen with the trade policy with the different countries that we operate with. Now, moving on into the second topic, which is the debt, we kind of touch it a little bit in the US. On the left side of this chart, what you can see is the trend of the debt pre-pandemic, pre-COVID, which was pretty the slope was pretty good already. But after the pandemic, we just forgot about it. We just said, you know what, whatever. And that's the problem we have is that trend on the debt, which is fueled by the deficit, it's unsustainable. It's not only a US problem, as I mentioned at the beginning, with inflation, it's also a world problem because the world has been consuming debt, that's been addicted to debt. And that's why we have seen good GDP growth on developed economies. On the right-hand side, what you can see is that right now on a global basis, we have about $315 trillion of debt. And when you compare that to the global GDP, the good news is that the blue line has gone from 360% to only 330%, 333%. The problem with that chart is that the reading is not that the debt went down or that the GDP went up. The problem is that GDP is measured in nominal terms and debt is measured in real terms. And when you have high periods of extended periods of high inflation, that reduces the debt in terms of the comparison with GDP, simply because we're including inflation in our GDP. But that's not good news. We really need that blue line to go down without the impact of inflation. That means austerity. And when you have austerity, you have less liquidity, and that has an impact with the markets. So depending on how this dynamic moves, we're going to have different impacts or not. Now, the bond market is actually looking at this, is watching this with eyes wide open. In this chart, what you can see is in the center is when the Fed starts cutting rates, and so the easing cycle. And you can see that the blue line, it's the average of the 10-year yields on the past cycles and how average behavior has been whenever the Fed approached the Fed cutting cycle and right after the start of cutting. As you can see, the blue line goes down as we approach the Fed start of the easing cycle, and then it continues down. In this case, the reason for that, or the rationale for that is, well, if the Fed is cutting rates, it's because it has inflation under control, the economy is okay, maybe it needs a little push, so yields will continue to go down. In the current cycle, you can see that right after the Fed started cutting rates, the 10-year yield is starting to spike. And part of the reason could be the uncertainty, part of the reason could be inflation, part of the reason could be tariffs, which could end up in inflation and that uncertainty. And obviously, the levels of debt and the deficit, that also applies. But in this particular case, what we're saying, and I guess the idea we're trying to illustrate is that this is different from prior cycles. And I am aware of this time is different, are the four most costly words of in the history of the market. So I do say that in that context. Now, there are dislocations in other places in the world. China is fighting deflation, and they have a problem with export consumption and the real estate market in China, and the yields of the Chinese, the 30-year bond yield in China is sinking. And for the first time ever, it's below the Japanese bond, 30-year bond, because Japan is now fighting inflation. Now, the distance in space between China and Japan is very little, and yet from the economic standpoint, they're two worlds apart. Inflation in Japan is going up. They have a huge amount of debt, 400% of GDP, and if the cost of that debt goes up, they're going to have a problem with the budget, and they're going to have a problem paying that debt. So what they're saying they're doing is they're printing money, buying their own bonds, and therefore that's why the Japanese yen is in the 140s, 150s, and 160s. And China is the other way around. Now, as a consequence, they're entertained, they're busy trying to fix their domestic problems, and they're not buying our US debt. And that's important because if China does not buy our US debt and Japan does not buy a US debt, it becomes a domestic issue. It's either the Fed buying the debt, it's either the banks or the consumers. And so we need to make it attractive to them. So in terms of credit, and we go back to duration and the treasury market, but in terms of credit, what we can see is that even though bankruptcies have gone up lately, the credit market, particularly the spreads, have not moved that much. And it seems that it's non-affected. It's kind of comfortable with the level of bankruptcies. But as you can see in the past, the correlation between, sorry about that, the correlation between bankruptcies and spreads is pretty tight. So it would not be surprising to see that this is going. Apologies for that. It's not be surprising to see that spreads will spike up as a consequence of those bankruptcies. Now, when you look at the credit spreads also compared with the level of uncertainty, what you can see is that uncertainty we mentioned at the beginning compared to spreads, in this case, investment grade, you can see that it's also a very good relationship. So what happens is that we wouldn't be surprised either if not only because of bankruptcies, but also because of uncertainty, spreads are starting to widen. They haven't done anything at all right now, at least on the investment grade. However, if we look at the lower end of the high yield market, you can see that the difference in spread between triple C's and single B's is starting to widen. And I think the triple C's are more nervous, aggressive investors. Whenever they see that something smells fishy, they start to react and demand more compensation for the amount of risk they're assuming. And I think that's starting to happen. Still too early to make a conclusion, but it looks like credit markets are starting to see something. Now, in terms of the obligations, so it's the newly signed Treasury Secretary, Mr. Vicente, has a problem now, which is he has about a fourth of the Treasury debt in Treasury bills. And that means that if tomorrow the Fed not only not cut rates, but started to hike rates, and inflation started to go up, then the financing cost of our debt is going to go up. And it's going to reset very frequently because we have a lot of money in the short term in Treasury bills in a month, 3 months, 6 months, and up to a year. So right now, his obligation, what he wants to do is he wants to extend duration. Here you have the average duration of the major economies. And as you can see, we are one of the shortest duration in our Treasury debt. So he needs lower yields to extend that duration into the 10, 20, and 30 years, because if he does it right now, he will lock in those interest rates, and the debt, the cost of servicing that debt will spike. And for that, we may need a recession or a convincing that we could have a recession. So the bond yields were actually going down. Banks start to buy long-term debt in anticipation of that recession, which will open the window for Mr. Vicente to refi that debt, which is 11 trillion that need to be absorbed by the market. Right now, if you go into poly market, the probability of a recession is about 40%. And we think that the probability of recession is not a linear business. So the difference between a 40% and a 90% probability of recession, sometimes it's 24 hours. So we take this obviously with a grain of salt. Their opinions, they change every day. So tomorrow it could be 20 or 0, but things are piling up. So it's something that we need to be mindful of and continue to monitor. Now, we also have a very good contrarian indicator, which is the IMF. What they're predicting right now is that out of the 180 countries they cover in terms of positive growth, negative growth, and therefore recession, for the first time in 40 years, they're saying that none, maybe one or two economies in the world will be in a recession. And as you can see, in 40 years, that has never happened. We have always have economies in recession. And right now they're predicting that none of them will be. Now, what happens to the US dollar? And what is the Mar-a-Lago Accord? So before the President Trump took presidency, they had meetings with technocrats from all over the country, different sectors, and those meetings were set up to come with a strategy for the next 4 years, and that's the unofficial name of those meetings is the Mar-a-Lago Accord. Now, on the left side, basically the summary is the U.S. provides the world with security. We have the biggest military in the world, and whenever something happens, we end up being involved, whether we like it or not. And two, we provide everybody access to our consumer base. We have 350 million consumers that they consume aggressively. So that's a big market for everyone. Now, in exchange, what the Trump administration wants is a weaker dollar. And why is that? Because he wants to bring manufacturing back to the States. So in order for him to do that, he needs to be competitive. And in order for us to be competitive without lowering the salaries and wages, he needs to have a weaker currency. Not too weak, because it will give the impression that the dollar is in trouble, but definitely a strong dollar does not work. Not when you want to have a manufacturing economy. Now, because they want to have a manufacturing sector, they're trying to protect, and that's the tariffs. So if we go to the lower end, to the lower part of this slide, what you can see is that they have two tools. One is tariffs. What they're using is to decrease or lower the barrier for U.S. manufacturing to flourish, which is not easy. And then the second thing is they talk about the sovereign wealth fund. Now, the idea of a sovereign wealth fund for the U.S. perhaps does not make that much sense at this point because we are an indebted nation. Typically, a sovereign wealth fund is done by countries that don't have debt or have very little debt. That is not the case of the U.S. And we right now have a very small sovereign wealth fund set up with the Bitcoin that was confiscated to bad actors. I don't think that's going to be enough to make some damage. However, if it's an idea that is pursued, we're able to control the deficit, we're able to control the debt, having a sovereign wealth fund to do some foreign exchange operations could be interesting. We still don't have enough details, at least we don't, on what to do with that sovereign wealth fund. Now, nevertheless, the US dollar trade was one of the crowded ones. Right underneath the Magnificent Seven, there were a lot of money betting on the strength of the US dollar, and that could be unwinding at this point. So we wouldn't be surprised that because this is strategic, or it looks to be strategic from the Mar-a-Lago standpoint, we think that the dollar can weaken. And if we look from the technical standpoint, it actually also makes sense. The blue line that you see is the real traded weighted index for the US dollar. And the white line is the commodities to equities ratio. And what you can see is you can clearly see cycles in this chart. Now, human eye tends to look for patterns. And in this case, this chart is making it easier for us. But what we're seeing is that if there is a weakening of the dollar, we should have a spike on commodity prices, which we're starting to see, as you've seen with the dollar, with the gold trading above $3,000 per ounce. And that's in absolute terms. But we also think that the dollar should weaken against other fiat currencies, such as the euro or the renminbi or else. Now, we need to be careful when, particularly the Trump administration, when we say we want a weaker dollar, because 41% of the revenue of the S&P 500 companies comes from abroad. So suddenly we can have an environment where our sales outside the U.S. yield less to us because our dollar is weaker, and yet, also through tariffs, we have a compression on our margins, right? Now, market concentration dynamics. The problem with our market today is that it has changed the way it works. So if you look at the market 30 years ago, it was active managers, the ones that dominated the market. Those were based on valuations above all, and you can sort of more or less ascertain the dynamics on how it was working. In today's market, even though it says 2022, it's more true today maybe than then. It's passive that dominates, and passive strategies don't think, so to put it bluntly, they just follow whatever the markets do. So they amplify movements to the upside and to the downside, we think. Now, in terms of the cash and how the active and passive allocate money, what you can see is that from fund managers, even the active ones, have now very low levels of cash in their books. And the reason for that is to minimize performance drag. And they need to minimize performance drag because they feel pressure from the ETFs, which have lower expense ratios. Now, if you look on the right, that's the cash pile from Berkshire Hathaway managed by Warren Buffett. And what you see is that it's a maximum, it's a $320 billion in cash sitting in treasury bills. And Warren Buffett is not the typical market timer. As a matter of fact, he prides himself as not being a timer, but he's very good at identifying turning points. And right now, what he's saying, without saying it, but basically his money speaks for himself, he's saying, I don't have clear options to buy anything, therefore I'm going to wait. In the meantime, the active and passive are fully invested. So there's, you can put your money on each side of this slide. I will put mine on the right side. In terms of concentration, 2024 was one of the most concentrated years in history, concentrated in the US, concentrated in growth style, concentrated in technology, concentrated in 7 names. And that little by little is normalizing through 2025. And we don't think that transition is going to be necessarily soft and easy. It's going to have a bumpy road. Earnings are normalizing. NVIDIA, which is the poster child for the Max 7 and the growth style, you can see that 2 years, last year, they were growing about 265%, and now they're expected to grow only 80%. And I say only in quotes. But eventually that 80% will become 60, 50, and 30, and therefore justifying high price earnings multiples is going to be tougher. The whole market is expensive. It has been more expensive in the past, basically in the 2000 and 2007, but still on the high end of expensive. And so what's going on is that the market is starting to look at alternatives because we ran up too much in a short period of time. What you're looking at is a chart by Goldman Sachs in a period of 2 years going back to 1928. They have broken out into quartiles and deciles. And what you can see is that the current market has broken to the upside with everything in the past. We're out of that cone that basically defines what a normal market is, even for bull markets. So typically when that happens, there's rotations. And some of the rotations that are happening are from growth to value and from the US to Europe. What you're looking at is since 1979, the performance for every year on growth style, the value, and growth minus value. So you can see that in the 1998, 1999, right after the Y2K, we have a huge run up in growth versus value. And you remember the Janus 20 and the dot-com era of the world. And then that was followed by underperformance of the growth style versus value, precisely because those excesses needed to be cleaned. Now, fast forward to today, this doesn't have any predictive power. We don't know what's going to happen. But again, we've seen the dynamic playing out. We can see a rotation from growth to value. Not necessarily on one go. It might rotate and then stop and then continue little by little. But we think that there could be a turning point for growth versus value. In terms of the concentration dynamics, we can see that more stocks are outperforming the S&P. That's good because the concentration is cleaning up itself. And on the right side, what you can see is that Magnificent Seven have negatively contributed to the performance of the S&P, and they still weigh a lot on the index, and that's why we're negative. But the other 493 stocks are actually starting to work out a little bit better for us, more on the healthcare side, consumer staples, and consumer discretionary. Now, the other story is money is flowing out of U.S. assets, in particular growth, sexy assets such as crypto or the Magnificent Seven, and you have the big drawdowns from 52-week highs, and it's going into Europe. And it's going into Europe into defense companies, banks, and a little bit of healthcare. And the reason for that, among others, is funny enough, also provoked by the US. Because the Trump administration is pressuring Europe to spend more in defense, so we don't have to, and we can control our deficit, supposedly. They're now, Germany has just passed by the Bundestag, the German parliament, just passed a $500 billion fiscal stimulus to invest primarily in defense and many other aspects. And that can contribute to between 1 point and 1.5 in GDP growth. And that's creating some tailwinds that, in conjunction to low valuations versus the US and in absolute terms, make Europe very attractive. And it's not only that, because it's not only the performance of European indices, it's also that the euro is performing very well versus the dollar, as expected because of the Mar-a-Lago Accord, and it's already 6% up for the year. So in summary, there is a reflation potential trend. We think it's coming back. How fast and how high will depend on how our ability to cut government spending. In terms of debt, we had too much debt and very high deficits. I think they're gonna wait on credit. And I think we're going to see something spreads spiking on the high yield market. The US dollar is going to be weaker by design. I think it's also going to depend on how all the policies work out with the tariffs and the debt. But we think we're going to have a US dollar ahead, not necessarily too weak, but weaker than anticipated and than in the past. And then lastly, in terms of concentration, we see rotation from growth to value. Again, not a straight line, and it's not a prediction. We think that it's time to rotate, but then whatever happens will happen. It is true that money is flowing from the US to Europe, and is looking for cheaper valuations. So everything seems to be rotating from expensive to cheap, from US to Europe, and from growth to value. We think that's the dynamic, because they're looking for tailwinds. Money is lazy, and they see that there's some tailwinds in Europe as opposed to the US, where we may have some headwinds. And so
Thank you, Gustavo.
With that, I concluded my remarks. So
yes. Thank you, Gustavo. I really appreciate it. That was very thorough. You kind of covered a lot. I'm sure we're going to have some questions. Want to let everyone know that Gustavo is also going to now kind of pivot and talk about his company Fundamental, some of the analytics that they provide money managers. I think is pretty interesting. So I wanted to have Gustavo show you a little bit of that, and then we can get to some questions on the overall presentation after he kind of goes through this a little bit.
Yeah, and I will take five more minutes of your time if you indulge me with them. So this is our platform. You guys can register on our website, myfundamental.net, at no cost. And you can see what I'm about to show you. I'm not going to bore you with all the details. Again, this is just a flyover, just to give you a flavor of it. But we have our ability. We have an aggregation of content. So part of the information that you see on screen, the opinions of others, and analysis from other asset managers and sponsors of our platform, you can find it on Fundamental. We have it here. For instance, what's the global house view from Aegon. Some of this content is only available to US offshore professionals. Other content is available to everyone, professional investors within the US and outside the US. And you can read it yourself and kind of give different perspectives on how the market works. And then in terms of analytics, what we produce is we give you the ability to do independent monitoring, independent follow-up of the markets. So for instance, if you want to see how the US equity sectors move and all these movement that I just mentioned from the macro perspective and how it's evolving, you have here a list that is public. You will find it once you sign up with all the different sectors of the S&P. Now, the information is updated every day at the end of the day, so you will see the NAVs as of yesterday. And then you have the performance of the different sectors. So funny enough, we have energy sector on top, healthcare, utilities, materials. And if you go to the bottom, suddenly you see semiconductors, software, and things like that. So you can see that rotation that I mentioned. You can see it on a year-to-day basis, 1 year, 3 year. We have different metrics, alphas, betas, volatilities, Sharpe ratios, drawdowns, and correlations. And you can do simple analytics with three clicks. So in this little button at the bottom right, you simply click, you select all the funds, you select the arrow, you click, and you select the time frame. Let's say 2020, 2023, for instance, 3 years. Click continue. With those 3 clicks, you have 8 studies where you can follow up the running returns for the different, so year to date, 1 year, 3 year, 5 years, normalized price chart, where you can have the different sectors. In this case, if they are funds, if they are ETFs, you can follow it very nicely. Correlations, Sharps for 1 year, 3 year, 5 year, over time, and 1 year volatility rolling. And then once you do that, if you want to create portfolios, and those portfolios you want to, for instance, look at the performance, you can create them in fundamental. It's very easy. And simply with 1 click, we'll give you analytics in terms of return, risk, distribution by asset class, currency, sectors, performance, correlation. You can see against benchmarks and the likes. So we even have some very simple scenario analysis where we tell you what can happen to this portfolio if it goes up, if the equity goes up 10% or down 10%, or rates go up 100 basis points or down. And you can produce your own presentations to clients with this information, with your logo and your disclaimers. So with that, Ed, I'm done talking. Happy to take any questions if there are some.
Absolutely. I appreciate your time today going through the market commentary and showing us your service. And if anybody's interested in looking further at what Gustavo just mentioned there at the end, get a hold of your CAPIS sales rep or contact Gustavo directly at his website, myfundamental.com.
.net. Yeah.
.net. Oh, yes, absolutely. Getting back to your presentation, you mentioned there was Poly Market showed a 40% chance of U.S. recession. Was there a time frame on that? I didn't.
So it's usually, it's very difficult to predict anything into the future. Joey Berra used to say, much more to put a date on it. I think the chances of recession are typically done within the next 12 months. But I think that is more what you get from that, at least what I get from that statistic, is people are starting to be worried about the potential recession because of the slowdown, because we're not going to be issuing more debt, and the part of the growth that we exhibited is fueled by debt. And then what's the impact on tariffs? Tariffs are a provide friction to the economy, and that typically slows down if they are deployed and if they start to be effective. So with those, I think that the poly market reflects that worrisome of investors regarding that. I don't, whether it's 40, 30, or 60, perhaps doesn't add that much value, but it's the trend in the fact that it's going up that that is important to us.
Okay, great. Okay, got that. That was a pretty interesting chart you showed about the rotation, kind of where we are, the 10 years going into say 2000. I like to think that with maybe the example of some tech stocks that were not as overinflated from a PE standpoint as we were across the board, maybe in 1999. But that being said, you definitely showed an indication toward rotating toward value,
We,
maybe European developed, maybe defense,
correct.
healthcare,
Yeah, yeah. So money
and
is now flowing from expensive to cheap. I think they're becoming defensive simply because of those dynamics that I just mentioned. So there's also some money going into emerging markets for the same reasons. Emerging markets, for the first time in history, have less debt to GDP than developed markets. So they don't have to worry about debt. And I think so. The US is about a $40 trillion market. Europe is about 10 trillion. If 25% of the money in the US decides to leave our shores and go into Europe, they will double in size, which is what we're seeing right now is, 20, 30% in Poland or smaller markets in Europe. So I wouldn't be surprised to see a very good year for a change in Europe versus the US. The question if it's a trend, we have to wait for that. But it's definitely the appetite to go outside, it's there.
Okay. And then the other thing I would say is, a lot of participants on our call are active managers. I think they were really interested in the one slide you showed how
Mhm.
much different, I think it was 1995 to present, how much was in active management then. And we all remember the stock picking mutual funds of the 1990s and
Yep.
really up until maybe the start of the last bull market when it started becoming more and more passive, concentrated in certain positions. Everyone would, at least the participants of this call, active managers, I think would like to see a return to more stock picking. In addition to a rotation of value, maybe do you think mid cap, small cap coming back more into play in the future?
So absolutely, I think small and mids may suffer if there's a recession or a deep slowdown. So that can be an issue, but definitely the problem we have of the last, I would say, 15 years after the 2008 2009 is that there has been so much money injected by the Fed that it's just you just needed to float and let the tide take you up. So there's no effort, and so the investors have become lazy. They don't want to pay an active manager to manage their money because if they just buy an ETF for 3 basis points, they can get the returns of the S&P. The problem with the active strategy is that they require discipline. If tomorrow we have a down 20% down market, they're going to have 25% downward market.
Mhm.
And that's the opportunity that active managers have to differentiate themselves from the passive. The question is, if they're fully invested and they have the same companies that are moving the S&P, we're going to have similar returns. So the idea now is we're going to see who's really active and how they can, and if they differentiate themselves from passive, we're really going to see some winners on the active space.
Yeah, and I think it became an unfortunate situation for even some of our clients and other money managers I'm in conversations with that had to felt like they had to own one of the Magnificent Seven names,
Of course.
whether for performance, for window dressing, like how do you not own this? And it became kind of outside of their discipline. They would be kind of this discipline, but you'd see one of the two of their largest positions were a Nvidia or a Tesla or what have you, to get back to kind of their grassroots of what they do and what they do best. And hopefully the returns are there and they
It's
can pursue that.
yeah, no, absolutely.
Well, I don't think we have any other questions at this time. So I thank you very much, Gustavo. I really appreciate your time today.
Of course. Thank you, everyone, and thanks for having me.
We appreciate it. And I just
Okay.
wanted to let everyone know on the call that we have a call next week on Thursday, March 27th, 10 a.m. Central, 11 Eastern, on transition management. That's basically the service where if an asset owner, pension plan, and foundation endowment is terminating one money manager, hiring a new money manager, CAPIS is a broker that can help you transition those assets and trade them into your new target portfolio. So some of the clients are familiar with what that is. If you're interested in learning more about it, if you're not sure as much, or if you are interested in potentially using a transition manager, this could be a great forum to learn more about that. That'll be hosted by Brian Gibbs, our head of transition management services, next Thursday, the 27th. And then Thursday, April 17th, we're going to be bringing back Markets Policy Partners to kind of go over political commentary, some macroeconomic stuff, and kind of see what those guys have to think. So appreciate everybody joining us today. Thank you so much. we'll be in touch with our upcoming events and hopefully see some of you next Thursday. All right, take care, everyone. Bye-bye.